Trump's 20% tariffs on Europe.
It's going to be a major blow to world trade, but I always think that also means there'll be opportunities.
Yeah, but in the end, America isn't the biggest anymore. Let them stew in their own juice, without any Dutch flowers this time.
What we're probably going to see is the EU hitting back with counter-tariffs, back and forth. They focused heavily on the current conflict surrounding Taiwan. There's now a massive Chinese military exercise taking place, where live fire is also being used.
What I found interesting is the whole Taiwan situation. Sure, if I were living in Taiwan, I would be seriously thinking about emigrating now.
So I was just looking it up. Do you know that graph?
Yes, I know exactly which one you mean. I'm looking it up.
I had trouble locating him for a bit, yet it genuinely seems that the human heartbeat remains constant each time. It's the global economic beat too. It's almost always the same, and I found that quite remarkable. I don't know if it's a hoax, but I believe I searched for it. It has truly been an original document from a man who forecasted those rhythms, and that continues to amaze me, because ultimately, sure, history doesn't repeat itself, it rhymes.
Guys, a lot has happened again, that's for sure. Like we just said, the timing of this podcast is spot on. With what Trump just threw out there, the US coastline just got raised a little, so to speak. When it comes to imports, we're going to go through everything that's happened over the past week. This week, of course, we're joined again by Marc Wesselink, our startup king, the reverse incubator car wash, so to speak. You'll have to explain that one later. Then we've got Mr. Cashflow himself, Mark Soons, author of the book Mr. Cashflow and builder of a great investment community. Also with us is Derk van Dam, lawyer and fund architect, and myself, Rowan Rozemond, hedge fund owner and currently working with Derk on setting up new funds. Well, it's been another eventful week, so let's jump straight into what it's all about this time. Trump's 20% tariffs on Europe.
Probably. We were already feeling proud of ourselves in the pre-chat for managing to record this podcast exactly today. It's kind of special. They're calling it Liberation Day. I'm curious to see how it unfolds. I'm seeing all kinds of assessments in the media saying it's going to be a major blow to world trade, but I always think that also means there'll be opportunities.
Yeah, but in the end, America isn't the biggest anymore. So well, let them stew in their own juice, without any Dutch flowers this time.
In that regard, it has always been true that our purchases from America exceed their purchases from us, thus considering that option.
Yes, I'm not sure. I'm not keen. But, of course, what we're probably going to see is the EU hitting back with counter-tariffs, back and forth. Will that also apply to things like LNG? I honestly do not know. Will energy be excluded from all this? I haven't seen or read anything about it, but it's definitely an interesting question. We talked about energy last time too, the costs involved. So I'm really curious to hear your take on this. Is this going to be a major blow to world trade? A major reset? Are we looking at a whole new global balance of power? I don't know, but I'd love to hear how you guys see it.
The novelty of posing such a headline is certainly amusing. It indeed serves as a light for the media to be it's thrilling to engage in. A 20% increase is indeed a considerable figure. I often ponder, well, we have some familiarity with Trump. Is it truly all-encompassing? But I rightly say, or no, I said rightly, is it also about energy? Trump can be quite vocal, he can shout loudly, and then it turns out they are actually implemented. No, but we won't rely on that. It amounts to roughly 500 billion in total savings from the entire discussion. So yes, I also need to see how the implementation goes, and indeed what Europe's reaction is. Look, if Europe's reaction can also be a blow to America, then I think we're just extending each other's lifespans, and everything is just temporarily 20% more expensive.
It does appear somewhat that way if I trust the media. But as you mentioned, the media, and indeed they often have their own interpretation of such matters. But on the other hand, when I see that tariffs on Chinese goods have now reached sitting, will China allow this to happen? I doubt it as well. This leads to countermeasures. Consequently, we are facing a full-scale trade war. I really think it's something quite remarkable, you see.
What is it that is remarkable, Derk? This has, of course, happened various times in the last 30 years. There was a consensus that it would disrupt the entire world, but it turns out that's not the case, as everything is interconnected. And ultimately, it also turns out not to be permanent. It always seems to be temporary, especially due to political motives put in place to make a statement, and then everything is rolled back and normalized. I think he just stepped in with his legs straight to look around and see, hey guys, where can I still make some space? I mentioned this last year as well. This is his modus operandi, nothing new under the sun.
Yes, it is always said that this is how New York real estate agents operate.
And that has its roots in Europe. tracing back to the Italian mafia.
Yes, indeed, but I often ask myself, isn't this just superior to real conflict? This is how he chooses to wage war. I've seen other presidents, so I once watched Trump during his previous term. He was one of the few presidents who did not engage in war, or at least he waged very little war. Yes, but he always approaches it through trade. And last time as well, he is waging war through trade. Isn't that simply a more effective way to conduct war with the world?
I see your point. What you're saying makes sense. It's a better approach than full-scale war. But conversely, if you consider it traditionally, a trade war is one element that can escalate into a full-blown war. So you see, yes, you start a trade war, that leads to shortages. Just look at Japan. Japan no longer received oil, which caused it to invade China to guarantee sufficient oil for their economic growth. Those oil shortages were a result of a trade war. It's quite a slippery slope, so to speak, to head in that direction. And I have a few more examples I could mention. More has come from this if we go further back to the English, who also took up arms against the Dutch for this reason, once. So yes, from that perspective I find it difficult, and I wanted to briefly return to the import figures. Because the US imported goods worth euros from the EU, while the EU imported goods valued in euros from the US, so that is indeed a substantial difference as well.
We know why.
This morning, I was driving and listening to a show on one of the major news networks. I won't mention the name. They focused heavily on the current conflict surrounding Taiwan. There is now a massive Chinese military exercise taking place, where live fire is also being used and so forth. It's a type of drill then, and I understand that people in Taiwan are starting to seriously worry about the intentions of the Chinese if the war in Ukraine continues to rage on. These trade wars that are developing now, it feels somewhat like a perfect storm in my perspective. Where is this going? Like, we can't foresee it here. I get it. And I doubt Mr. Trump listens to this podcast. You never know. But, okay, the English translations are good. Our English voices are nice, definitely. They also appear to be similar. But still, these are all matters that when you add them up, and if I let my historical awareness pass through my mind, I've never encountered this in such a manner before. All right? One of our discussion points today is, of course, what does this mean for investors and for capital? Never waste a good crisis. But still, how will you translate that? Where will those opportunities eventually arise? I believe that's what our listeners are eager to know.
What I found interesting is the whole Taiwan situation. Sure, if I were living in Taiwan, I would be seriously thinking about emigrating now. Only if you examine a share like TSMC, Taiwan's largest chip manufacturer, then it's only down about 11 or 12% this year. Conversely, if you consider the investors, they currently perceive minimal risk. If China were to invade Taiwan, naturally, they referred to this in the World War II years, but it stems from a leaked piece of information. Conversely, how should we read this? Perhaps it's merely propaganda. Moreover, the real question is whether the Chinese would take that risk during a Trump presidency. I believe it's wise to hold off for now. If I were in China, I'd wait. Indeed, with Trump, you can never really predict what might happen. He is quite hard on China. I think if I were to sit in a Chinese chair, I would first take a look at what the trade war is doing. What does it yield us? What does it cost us? And then you would start taking steps here, like an expansion, from their perspective, addition of Taiwan again.
In addition to this, the United States maintains an official stance of a one China policy, which makes this situation all the more bizarre and unusual. It is stated that we support Taiwan in its pursuit of freedom. How that should be done, I'm not sure. On the other hand, the one China policy is still officially advocated by the Americans. There is no ambassadorial post in Taiwan. Also, no embassy. It reminds me a bit of the Dutch soft drug policy. You are allowed to use it in coffee shops, but growing it is prohibited.
You can't buy it, but you can sell it, though we don't want to see any purchase invoices. It's similar. This situation is chaotic, but it often involves action and reaction. We'll see. Sadly or happily, we cannot foresee the future, but it is indeed a bit odd. That's an understatement. Exactly what we just said. Never waste a good crisis. I think that I was just searching for it. Once again, surprised by the graph. In the 19th century, someone made predictions trends all the way to the 2080s, and he turned out to be remarkably accurate later on. He also predicted the stock market strength in the early 19th century, but also the stock market strength in 2007. So I was just looking it up. Do you know that graph?
Yes, I know exactly which one you mean. I'm looking it up.
I had trouble locating him for a bit, yet it genuinely seems that the human heartbeat remains constant each time. It's the global economic beat too. It's almost always the same, and I found that quite remarkable. I don't know if it's a hoax, but I believe I searched for it. It has truly been an original document from a man who forecasted those rhythms. And that continues to amaze me, because ultimately, sure, history doesn't repeat itself, it rhymes.
This is indeed this picture. And yes, there is some controversy about it, but I believe it is indeed quite old. He developed it, as far as I could find, not in the years 1929, but a bit later. He takes it a bit further back, and then he actually calculates it forward to the future, as I understand it. But yes, here it is indeed very interesting because it runs quite well in similarities, because in 2019 we of course had COVID and the COVID crisis, and then we go to 2023, which is the peak year. Well, 2022 was also quite a tough year for the stock markets, of course. It is tricky, but good. In 2023, we reached a peak again. And yes, we are going back to 2026, which again, yes, years of good times, high prices, and the time to sell stocks and values of all kinds. So 2026 is actually modeled here as the peak, and maybe it's fine to sell again and wait until 2032 to buy again. And I think that has always been a bit of my theory, that yes, this period will be choppy sideways in the stock market and such, so you need to implement other strategies if you want to achieve results, because if you just buy the stock market, probably from 2019 to 2032, nowhere at all, is my theory, of course.
The consequences of the trade war on supply chains and similar aspects are indeed fascinating to analyze. We discussed in an earlier episode the EU's desire to establish a European defense using European products. Is this possibly a reflection of the American drive to bolster its domestic industry? We will do this in Europe too. If we can't trade with the US, we'll manage on our own.
Let me take a very recent example, okay? Cars were sent to Russia while we imported oil from Russia. That was under sanctions. I'm not sure if you've seen that documentary, but there's one from the BBC showing cars heading to Russia. Picture driving luxury vehicles. They were reportedly in Kazakhstan, where there were no sanctions. They crossed the border into Kazakhstan. I believe the statistics literally indicated that approximately 400 luxury cars went to Kazakhstan, and after the sanctions, it increased to around 40,000. Now that was an extreme difference. And with oil, of course, oil was sold from Russia to Turkey. One might say European Union. Turkey did not comply with that sanction. Crude oil was sent to Turkey, refined there, and subsequently arrived at the Rotterdam port. We all thought that was fine. It all happened. If you then look at this, the latest tariffs, the problem is if you do that very regionally, we will first send it via Venezuela, because Venezuela made a deal with Trump. So why not send it to Venezuela first? Their imports and exports have multiplied 10 times in recent years. And then we will send it to Europe. We have no problems with that. It is so difficult to get this closed off. You just make it a bit less efficient. But on the other hand, you have a reason to raise your price to the consumer again. So I wonder if it, yes, of course, here in the margin, but whether it is felt in the entire chain is truly felt in the margins. That's still uncertain for many products. Certainly there is a top line where you will definitely see it. But I think there is also a very large bulk where tariffs won't apply, but will pay indirectly to other suppliers. And that could also be a positive aspect of world trade.
Indeed, I believe that primarily the consumer is affected, rather than the one who moves it from point A to point B.
What I would like to argue is for ourselves, yet we aren't taking much action. To those who are in charge, let's indeed focus on becoming more industrially independent in Europe and regain some level of self-sufficiency compared to our current state. Because as you can see, you can't completely depend on global supply anymore. In my opinion, this is also a huge opportunity for investors and entrepreneurs in the European economic area. I agree.
And I believe that global trade, as we've experienced lately, is truly global. Global 3.0 eventually turns into a politically motivated scenario. Therefore, you must always take that into account and never bet everything on it. I believe, as the saying goes, every man has a plan, every woman has a second plan, and every entrepreneur has several plans. You should approach it similarly, always looking for alternatives if one thing doesn't work. We must not be dependent on one party anymore. It has happened several times that we count on a country like America. This is completely nonsensical, of course.
No, this is also a point I raised in the last episode. We were all in agreement. Let's choose trade over conflict. So things are shifting a bit now. As mentioned earlier, a trade war isn't a shooting war. Let's proceed. However, it often acts as a precursor to that. I would consider that quite regrettable. In other words, that's an understatement of the year.
Also, fortunately, due to global trade, England has found alternatives to Dutch flowers. And back then, they didn't have any alternatives. Japan also has alternatives through global trade regarding energy. The fact that we can no longer be easily isolated, as we have alternatives through global trade, reduces the likelihood of it eventually escalating into a war over global trade. That's amusing.
That is correct. That is correct. But only in cases that are very unique.
Regarding energy, I believe it poses a problem. You can actually observe that as a catalyst. In terms of energy, if a nation can no longer afford inexpensive energy, then you really have a problem, because then you get uprisings. Then you get a population that is fed up.
Now, significantly more crucial than it was before, we are fully dependent on energy now.
Products, I'm relieved I'm not a German car maker. I must say that too.
Unless you can make a tank out of it.
Volkswagen said that, huh? We're going to do it again. What do you want to do? They say Mercedes were made like tanks before. No, but seriously, China too. But there's a significant export of German cars to America. I wonder how that will end. The German economy is not exactly in the best shape. There are some implications to consider, you know, for sure.
I believe this is fundamentally a discussion about self-sufficiency. How self-reliant are the various regions and nations? Yes, some experience this more intensely than others. Some feel it more in energy, while others feel it more in technology, and others feel it more in the automotive industry. Yes, I believe this will lead to a fascinating dynamic between merging and individualism. Therefore, this is likely to result in a stronger Europe, or will it also be a more individualistic Europe? They believe that, yes, we are experiencing some stress, and they either look inward or will they come together and, in any case, draw some strength from it.
And you are inquiring if this ought to result in enhanced economic partnerships within Europe. Who am I?
You can witness this taking place on every continent. China, of course, is also involved in this now, COMAC. They are currently manufacturing their own aircraft, thus to reduce dependence on Boeing and Airbus, because they have also seen how hard it is for Russia without components from Boeing and Airbus. Because that is indeed a real problem that the Russians face. The number of Tupolev crashes will increase again in the near future. They might need to depend on it more. But then again, building such an industry is a different matter.
It is their belief that the pilots consumed alcohol during their flight operations.
But if you establish such an industry locally and reduce your dependence on it, yes, then your economy can also function better. And China has heavily invested in a high-speed network, which of course really benefits France. Its economy has been set free. When they initially began with high-speed networks putting things down, I truly see that they are making decisions that look more like the growth of the middle class. The question then is whether China eventually remains so reliant as we gamble. Because I must honestly say there is little good data. As we gamble about, we always think China is completely dependent. And the view that many Europeans and Americans share is that Chinese people live near factories in poor conditions. This is indeed the case without a doubt. Just observe at those massive cities. People live there too. They create a fully operational ecosystem. China is already making significant progress as well. They possess their own economy, and I question whether that is clear enough. I sometimes think, of course, when politicians concentrate on their own economy, that's fine, but don't underestimate the other. I believe that is the greatest risk.
If you've ever been to a big city in China and you've been to Shanghai once, then it's a pretty bustling economy there. Oh, indeed, a bit of affluence.
However, that's a great transition to the title of this podcast. We seek yield. Sure. Where must you, well, where can we say something we celebrate about where you as an investor should focus in the coming time?
Given this development, yes, I had a meeting with some clients yesterday, which we hold quarterly, where we talk about entrepreneurship and investing, the good life, and we have a lovely meal together. I always provide a brief masterclass on the future or on the trends I observe. I mentioned two things that I conveyed to them, and one is to focus on assets, meaning focus on the, as you can see, the price of gold has changed over the last 2 years. So I displayed data from the past 30 years, but if you only look at the last 2 years, the price of gold has doubled. Also, it hit $100,000 this week, so per kilo. So the price per kilo of gold is at $100,000. I have always grown up with the idea that gold, yes, does not increase in value. It keeps your buying power intact. Well, currently, it's increasing quite quickly. It's going faster than inflation. You can see that raw materials and, for example, housing prices in the Netherlands, they just keep going up. But just the part of your portfolio in physical assets, I still find that very important, essential for individuals. The second thing is, of course, that I find cash flow as part of your portfolio. So I invest in cash flow, generating assets, very valuable, especially since economically things could still falter soon, could possibly drop in the upcoming period. Indeed, your business may encounter difficulties, or your job might be in jeopardy. Therefore, that's at least a sort of safety net where I have outlined two key pillars. Additionally, yield seekers are certainly exploring where the opportunities lie in the market. This serves as protection against the market, but where do the opportunities exist in the market?
Yes, if you go buying gold now, I think you're already behind. I mean, that rally has already taken place. Of course, there is still some upside potential. That's definitely true. However, I believe you've already seen the largest shift. In reality, prices in the market anticipate future conditions. They do not merely reflect the current state, instead they are shaped by expectations about what lies ahead. Thus, this creates a significant challenge. You can observe that Rozemond is going wrong. He believes that he sees, I now observe the military buildup. Perhaps I should invest in stocks of the defense sector. No, those prices have already risen, they are already forward-looking. That reasoning has already been established. This indeed makes the market difficult. Yet, it is also intriguing, it is intellectually engaging for many to think beyond the present day. Marc Wesselink does this with startups too. You need to look forward. You don't consider what the business is worth today. The fact is, it has no revenue. You haven't solved the problem yet. So, I offer you €1 for 50% of the shares, because that would be a realistic valuation. But that is not the case, of course, because you look ahead. What is the potential of that idea? You do this in the market as well. That's why you dare to invest. I believe this is a mistake many people make. There is a significant amount of FOMO. People are willing to take the plunge into something that's already on the rise. I fully concur with you, Mark. It's essential to concentrate on assets. I truly believe that. However, it's crucial to be cautious about FOMO. And don't jump into a market that is already rising. End of day. The focus is on capital preservation. Entering a growth market signifies capital growth.
It goes without saying that, as the leading startup, the ideal choice is to invest your funds in startups that are primarily AI native. This doesn't mean they sell AI, but that they integrate it into their product creation and the marketing of their offerings. They include AI components. Currently, you can observe that the time to reach 10 million in annual recurring revenue has become absurdly quick. It's hard to believe what has happened over the past few years with firms that have 12 or 15 employees suddenly exploding to 10 million ARR simply because they have AI at their core. We find that quite impressive. I also think we are currently working with a few entrepreneurs to utilize AI for global trade. So how can we eventually assist small entrepreneurs in getting their products to the farthest corners of the globe without using big networks where you end up losing 30% of your commission? AI can also be wonderfully utilized regarding settling the local regulations, however, and also to leverage it in your favor. Thus, I genuinely perceive a vast number of opportunities in global startups centered around AI.
Well, that seems...
Very nice tip for our listeners to take away. I added to that, we were just talking about that phase when the market goes well and when the market goes bad. I think if you go until 2026, if you're already in position, you're fine. Then there's really some upside to be found. But I still think if you look at that overall market, and I think that's an effect of Trump, of the tariffs, of the macro-economic picture that we are in, is that stock market and not the startups. Wesselink will think differently. Of course, many people want a diversified portfolio of also the traditional assets. I think if you are in position now that you can last quite a while, but you still need to look at alternative strategies that are actually not correlated to the traditional stock market as well. Many people think that if I'm going to invest, I'm going to look at the traditional stock market. But there are so many asset classes. And of course, the stock market to commodities we just mentioned, and gold and silver. But you also, of course, just have the alternative strategies. And so derivative trading, for example. But also, you have also in the energy GYR a lot of opportunities. And well, solar parks seems to me now a less good idea, because you see there is really, you can buy them nowadays for a few euros. I don't know if you noticed that if you want a solar park, you can literally buy it now for a few euros, and everybody wants to get rid of it because you stop the feed. And
in the Netherlands, well, we have a global market, fortunately. It is strange that you put very expensive assets in a place where they don't yield the best return. I would put a solar farm in Spain and not in the polder.
Yes, but it's much more about the grid, and you have to be able to put that power into the grid. The problem is a bit that our infrastructure in Europe is so bad that if you generate it in Spain, then you don't get it in the Netherlands at an electric move, so to speak.
You do have better efficiency there?
Yes, or just go and eat in Spain. I mean, I think even better idea.
You can do a lot in Spain. That's totally fine.
But you have so many more asset classes you can be in to diversify and not just have exposure to that stock market that is forward looking. But if you invest in a company that is making returns today and tomorrow, then that doesn't look at the stock price forward looking 5 to 7 years into the future. So sometimes you also just have to choose what assets you do and not just purely looking, I'm going to invest market US S&P 500, and that's...
Plus, of course, there are a lot more alternatives now. So you can also often invest directly or indirectly in private equity funds. You can invest directly and indirectly in PC funds through all kinds of platforms. We are, of course, a bigger association of CC than P, private equity. Venture capital is, of course, a part of private equity, but we really do believe in the AI native for the next 5 to 10 years. I think a lot of SMEs are not concerned with that at all, and therefore with private equity would have a harder time, and they can be overtaken by companies that started yesterday. But of course, we at Duck recommend, in the end, you can have a much better spread than ever before. And that doesn't always have to be through your banking app, especially not because then you only get commission, but you can very easily manage your asset through different platforms in the different classes.
Yes. There are also a lot of people who don't actually understand startups and scale-ups, of course. What do you think about all those funds that's springing up and often targeting people who have somewhat smaller wallets and therefore are often somewhat less informed?
Look, if you, as a small or a retail investor, put all your money into startups, that's fine to do. But then at least 600, a historical data that when you have more than 600 companies in portfolio, the likelihood of achieving a 2.5 times return on your investment is almost 98%. Yes, not many people have the getting access to 600 startups. They plan to achieve this through various funds. Once more, it's important not to invest all your money in a single asset class. So if you, as a small investor, so to speak, every euro you have, 2020, you're generally safe from 20 cash, 20 real estate, 20 liquid. Yes, as far as I'm concerned, the rest in private equity. Then you do have of 20% private equity, so later stage, and 20% startups. That's totally ideal. Nobody does that, by the way. Venture capital is a tiny part of private equity, which seems strange to me. But if that is your spread, yes, then I think you can stand a lot, then you have a resilient portfolio.
The entrepreneurs often have private equity 70%, and those are their own companies. That, of course, is also private equity. That bid heavily on their own business, of course. However, if you are well acquainted with that game, then why not proceed further with it? What is particularly troubling is that it is now very evident in portfolios that there is a strong emphasis on a specific geographical area where all aspects of private equity are either situated in Europe or entirely in America. Thus, I still hold the belief that you, especially in this current world, you want to spread out a bit more over continents to hedge your geographic risk to close. But I really do think that this is a time of diversification. Yes, that 2020, the division is really quite a lot neat. However, yes, I always say when talking to someone about it, my way of looking at it is you need to be aware of how much cash flow you wish to obtain. Just locking everything away is not effective, and you must also eat if you're only considering your investments. Considering the cash flow you are getting is essentially Mark Soon's story. So I won't go into that any further right now. Then you need to think about what kind of diversification you would like based on asset classes. And then you start looking at what diversification do I want based on geography. And you do have to include all of those, and often someone will stop at one of those stations while creating his portfolio. I make sure to have a year's cash on hand for future needs. I can create liquid flow from my investments so that I can ensure that if something happens, it won't be a problem. It's been a year since something happened. Rebuilding has taken a considerable amount of time. You stay resilient, so to speak. I notice that many people either get stuck for an extended period or do not get stuck whatsoever, diversifying or not looking at a cash flow and getting into trouble later and then having to take it out again despite being professional investors. Then they behave a little bit like retail, and that is, of course, we have doomed before, I think in episode 1 is the problem with how do we qualify them? Well, what is a professional investor? Well, in the Netherlands, we still go to okay, invest 100,000 euros or more. All of a sudden, you are a professional investor. Whereas if you inherited it from mom and dad, then you really don't have the knowledge to qualify. In my view, this can be classified as professional. Giving them a test would result in nothing at all. And of course, that also makes a market for influencers who don't always paint the picture that best fits what is best for those people. So you will really, and I very much believe in that, to an asset manager, to a portfolio manager who takes a holistic view of a portfolio only. The problem is, if the portfolio is too small, under 5 million, you have basically zero access, or just again, those banks who want to stop doing that as well, because it doesn't make anything for them, not really giving solid advice as they are product oriented on their own products.
Anyway, there is already an answer to that. Robinhood in America has just announced a private wealth management system created on AI, based on AI. So then you can actually, through one app, you can access the global market of assets. And that can be exactly in the different classes, what we just discussed, with also a kind of AI component in it that tells you, well, do a little less in this class, do a little more in that class. So that's coming.
I certainly think that this can be a very nice addition.
Are we going to the future that you have a kind of private wallet which is connected to different asset streams where you can make your own or assisted choice? And actually with one click, yes, we preach that ourselves in 3 clicks investments. We are building a number of companies with our portfolio at Venture Work. That allows you to invest in a company in 3 clicks based on evidence, real-time evidence. So no bullshit story, just being able to look directly into the kitchen of a company. With a digital registry, you can have that done in 3 clicks. With a digital identity, you can facilitate that to have an investor invest in your company in 3 clicks. What you're currently doing, 5 to 6, we are now in the process of an 8-month journey to make an investment in a limited liability company with a notary involved. This makes absolutely no sense at all. That also really doesn't make any sense at all. And we also just see that that's going to happen through that wallet, because that wallet is actually your private self-sovereign identity, as it is neatly called. That's your identity, and that's how you manage different portfolios. And that's only good that that also becomes accessible with the right advice, and not we at Duck recommend Duck, as with banks, who, of course, tell you to invest in the bank's funds, without knowing that 2.5–3% management fee is charged over it. Just direct access in finance, especially decentralized finance, cut out the middleman.
I absolutely agree with that, but it is still somewhat, here comes soon's problem around the corner. Where do you invest then? Because if you have direct access, you have a lot of choices, and then you don't know. It's not your focus because you're busy with your business or you're busy with your job. So you don't know where to go, and that of course makes it very difficult for a large number of individuals. There remain options. Indeed, I fully support direct access. However, it also results in a sea of choices.
What you see now is that an AI asks you, what are your hobbies? What do you like to do? What do you want to get behind? What is your motivation to be on this world? And from that, he ultimately matches an investment profile to that. That's the future. And that you also proactively from that profile of just watch out. Because now it turns out that the fund not so SDG and is going to invest mainly in the defense systems of Dassel, because they have been instructed by their larger investors to invest more in defense. Yes, then you can just get out. And obviously as an individual, you could never do that. But because you get that information to you based on your personal profile, it becomes a different story.
And just so you know, this will happen. Of course, it does depend very much on how such a system is fed, because AI is of course never quite I. It also depends.
Garbage in, garbage out. So an AI will start asking your questions, and on the quality of those answers of your questions, of course, you already get a lot, just as the current AI also works. Yes, if you give a bad input, a bad prompt, then you get a very bad output. Yeah, but the moment you ask a very good question and give very good answers, you get the right output. I'm very much inclined to agree.
Very much with you, Marc Wesselink. But that's another piece of supervisory problem to overcome, isn't it?
Well, look, I think there's a nice segue there to the next topic, and that is how America's FDIC has actually indicated how banks should deal with crypto, that they actually opened up the floodgates for banks to start picking that up. And I think that that is actually quite separate. Again, despite the fact that we want it all to be open and honest, and you name it, it will eventually lead to integration into the bank app. And eventually the same, I find myself somewhat concerned about the oversight of that bank, particularly in light of what Derk has mentioned regarding this aspect, is regulation, 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 and protection, 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 protection. Because from a government perspective, we don't fully trust AI yet. And on top of that, if you look at Europe, and especially the news lately, is that we are starting to have doubts about everything that is American. I read an article that was about that we may not trust American weapons anymore. So the ones we still have, we may have to start distrusting as well. That's really going a step too far. That's really nonsensical.
But in my view, well, that gets shouted a lot, of course. But from a regulator standpoint, I can imagine, well, regulator, legislator standpoint, whatever you want to call it, that investing through an app, especially if it's about substantial amounts of money, that's not just, it might be made possible in the Netherlands, actually in the EU, because that isn't EU. How do you see that, Marc Wesselink?
Ultimately, it's about a compliance trail. You are able to ask a series of questions that based on those answers can make an informed decision. Because ultimately, it's the consumer himself who decides to take an action, not just the AI, only the AI that advises you based on your input. That asks questions of you, and based on the answers you give, it will give an advice. And ultimately, the human has to, like good advice, press an action. You can't let an AI do that. The moment you get that compliance trail right on the data side, on the back end, then it's really the same as an advisor from the bank giving you advice based on often the same data points, but maybe less time or got out of bed with his wrong legs to misinterpret a particular news stream.
And so then essentially as a retail investor, you're your own asset manager in this, right?
Yes. Only you do have direct access to a knowledge based on your personal profile, be buying or selling one, two, or a pick. Because if you see now how that is distributed, there are obviously a lot of middlemen in between. They all come from that industry. So we also know how an awful lot of percent is lost to all those middlemen, and that all comes at the expense of retail returns. That's really shocking.
Wesselink, if you remove those people from the equation, I frequently hear the phrase, this is too good to be true, which is of course conditioned by the entire context, market. The whole idea that a low return implies a low risk and a high return implies a high risk. That still beats it. I mean, if you buy a property with all the defects and it yields 4% a year, which a lot of people in the Netherlands do only, yes, well, we don't have so overdue real estate, but there is really in between. Then you do suddenly have a low risk, then you have a rotted foundation that puts your whole investment at risk. And the same goes for high return, does not always bring high risk. I mean, if you were in Bitcoin, had invested in at 2017, then your risk return is lower than that property I just described. So from that perspective, that whole risk calculation, and also if you go look at how regulators look at volatility, so they link risk to emotional instability because that's volatility. They do not link risk to whether you or it is actually a risk because volatility is just emotional instability that ultimately leads to an investor losing something.
That's not even counting the brokering margins that are added to that if you just do this directly.
Well, that middleman may well become a little bit less happy with that over time then. Yes, but of course that's the past.
It's been happening for 30 years also in global trade and in big commodities. The middlemen are not happy with that as long as you can add values at part of the chain. And if you just capture values from that chain without adding, then you get cut out. Simple.
That is strange. In that context, indeed, the bridge you just made, Rowan, to another agenda item we had identified, the new rules for banks regarding crypto activities. There will be new guidelines, right? You had looked that up? America has now implemented that. Yes, exactly. Europe is already full, though. I think so, too, huh?
You're going to start to see that you're going to be able to do more and more with crypto. Honestly, how I always looking at trends and looking at investment propositions is generally businesses choose the road of least resistance. Also, as an entrepreneur, you end up choosing least resistance because it's already all resistance. As a startup, altogether, everything is resistance. So you choose the road of least resistance something. What works if someone also doesn't get to the product market fit? Then I think of, will you look for your resistance? You look for the solution, right? Anyway, the path of least resistance. And that works the same in an existence company. That works the same in world trade. One always looks for the path of least resistance, and that is crypto. In this case, if you look at that trend also, because crypto is ultimately for a government, also the least resistance when it comes to control on what happens. Crypto is no longer black hole where you don't remember what all happened.
But it's never been it, by the way. Everybody thinks of crypto as a big hole, but they don't realize it's continuously traceable because you just have a public ledger. So it's been that way from the beginning.
Established, yes, but you had no connection between the private person and the wallet. That was the reason for many to label that which is fine to solve and has been solved already. But well, it is the path of least resistance, because if you now look at how our financial system works, Bank One has a big book account, has a big book of all transactions. And Bank 2 has a big book of all transactions. In the Netherlands, we have said we hang that up pretty well. If you look worldwide, then these banks can be like, if the bank one forgets to delete something from the ledger and the other one writes it down, suddenly money has been created. And that happens daily. You will be really surprised how many mistakes are made in that, and you can solve all that with crypto, and this amounts to a considerable amount of added value for a government regarding the economy. Indeed, we have previously discussed the significance of transaction speed, which is crucial for the effective operation of an economy. From that perspective, crypto is the middle way ferry, which you will start to see more and integrated without people going ahead, because in the end, and I have always said that in the end, the blockchain is just behind your transactions and you have no idea, and have you still that you don't have Rabobank ABN, you don't have through.
Yes, that's an interesting one. If you subsequently link that together, take a moment to come up with an idea. Currently, regarding the AI applications that Marc Wesselink has just mentioned, then it becomes a very fluid situation at some point. But yeah, that doesn't have to be wrong
Artificial
at all, does it?
intelligence, you won't even notice it. That's what I'm saying. Dirk, I think that was 3 months ago when I saw you. Have someone reach out to you who was interested in implementing an SEO enhancement for your website, and it turned out to be an AI woman, which you could easily notice, hardly noticed. She is particularly skilled at revisiting the objective of the meeting, which is to arrange an online appointment. If you think about how AI can easily make a phone call and conduct a thorough conversation with someone, and 25% of people aren't going to realize that, and that goes to 9 and 90%. And that's about to go to 100% of people who do not realize that. And I do not know if you guys have even seen video in a scenario where an AI makes a call to another AI agent and they realize they are both AI agents, leading them to think, let's communicate using beeps, since there's a certain that is faster than communicating and with each other, a much faster way of communication to come to a booking. In that example, if you look at where it's going, ultimately, you just have your AI agent who calls another AI agent for you. And the data is available to you, and if you want to know something yourself, then when you converse with an AI agent, I confidently assert that if you engage in this manner, you are moving towards a reality where you can once more make calls to businesses that operate a call center allowing for standard communication. With most parties where you now get to such a website and don't even know where the help desk is because they put it as far away as possible, because that's apex in the...
Yes, once didn't they? It is. Of course, I also heard that story of those AI agents calling AI agents. I think that's maybe that I'm a little older. I don't know. There's a danger in that, though. Yeah, if at some point that it starts to be self-learning processes, which are going to be chatting things up with each other. A lot of films have been made about this in the past in Holland. No.
But as long as there is no decision-making power behind it, but who decides that? That must be very well secured. Ultimately, humans decide to what extent they will let AI integrate into his daily decision-making power. I compare AI a bit to an exoskeleton. An exoskeleton you park against the wall and do nothing at all. But the moment you stand in it, it can lift 10 times as much, do 10 times as much to you. And that's how it should stay. It shouldn't an exoskeleton that you say, lift me up.
Yes, but that of course. How is it assured? I sound like a government now. How is it assured that that is not going to happen? There are also AI weapon systems being experimented with now. Also by the Chinese, also by other parties. Yes, who ultimately decides whether such a thing, an AI drone, pulls a trigger or not?
A company decides that we are already there. That drone decides whether the target is...
But not pulling the trigger yet, so heading the action there.
No, that already exists too. Really, that already exists too, is about the level of human input. And because if you also look at, what is the name of that American company again? Para something with AP, individuals who are heavily focused on AI. And if you examine how they perceive battlefield decisions, so to speak, that is indeed the ultimate choice in the command hierarchy, which is determined exclusively by AI. That initial decision, battlefield overview and its location, do we have to attack? Where do we have to attack? Do say, okay, we send drones over there to attack in that area. Only the final decision. This missile goes into this tank. That makes AI now...
Yes, those are indeed things that are being worked on and experimented with now. But I still see risks to that, though. Especially if what I'm saying, it's going to be like that at some point. And that seems to have happened already. Making decisions together to take out people. Yeah, right. Maybe this is a very old-fashioned approach here. It could well be.
Speaking of AI, AI is now telling me I have to leave to be at my appointment at 9:30. Yes, that is very convenient, based on the red lines that are left. So I'm going to leave you guys.
Yes, we are going to end it because we have been talking for another hour. Indeed, while there are many fascinating subjects related to macroeconomic trends, they can frequently be linked back to personal portfolios and investment strategies. Going to see the next week again, going to notice the impact of all the trade tariffs. We always record this podcast on Thursday morning at 8 o'clock and then comes online on Friday at 10 o'clock. So what all happens in the meantime, you're not going to hear from us, but I'm sure we'll discuss it again next week. I want to thank everyone again for listening this week, share and like this episode. Thank you so much again, and we'll see you next week. Bye.
Bye.